Welcome to today's webinar, Social Impact Investing, Promoting Positive Change Within Your Portfolio. Thank you so much for joining us. My name is Corinne Solera, Portfolio Manager and Investment Advisor here at Bell Investment Advisors. I'm joined by my colleague, Investment Advisor Heidi Stoltz. Before we begin the presentation, there are a few housekeeping items to cover. If you are experiencing technical difficulties, please call our office at 1-800-700-0089, or you can submit a request for assistance via the questions box on your GoToMeeting control panel. If you have a question during the presentation, please submit it via the questions box. If we are not able to answer all questions today, we will follow up with you via email after the presentation is over. All right, we can now get started. Today, we plan to give you a brief introduction to Bell Investment Advisors for those of you who are not familiar with us. The focus of our presentation, however, will be on social impact investing, what it is and how it has evolved. We will explain environmental, social, and governance criteria, also known as ESG, and how these tie into social impact investing. We will discuss how the screening process of social impact funds has progressed and also address the performance gap myth. We will end with details of the Bell Social Impact offer. Bell Investment Advisors was founded 25 years ago in the year 1991 by our president, Jim Bell. We are a privately owned, registered, independent investment advisor located here in downtown Oakland. We have 3 distinct service offers, including investment management, financial planning, and career and life coaching. We work with individuals, foundations, nonprofits, as well as small businesses. And we have just under $500 million in assets under management. I'll now turn it over to Heidi to acquaint us with social impact investing.
Thanks, Corinne. Recently, as we've been having conversations with our clients about their goals, what's important to them, and their investment portfolios, we've heard more interest in investing in a way that aligns with their values, in a way that clients feel good about, that focuses on the causes they care about, and sometimes even excludes the areas they don't wish to support. As advisors, it's our goal to help our clients find what they're looking for and provide options, and that's why we're offering social impact investing. This type of investing is not new. It actually formally began in the 60s. And over the years, it's been given many names and many titles. So you may have heard terms like community investing or green investing or socially responsible investing. And these terms essentially all mean the same thing. And for our purposes, we're using the term social impact investing. So social impact investing aims to align your portfolio to your personal values. You can decide what is important to you and to your legacy and invest accordingly to leverage your financial assets for the greater good. That can be done in a variety of ways, which we'll cover shortly, but broadly speaking, social impact investing focuses on companies that are sustainable, responsible, and impactful. And when determining if companies are making the grade, environmental, social, and governance criteria are often considered, and as Corinne said before, you may hear these criteria referred to as ESG. In this slide, we have listed some of the ESG criteria detail to give you a better sense of what this entails. So when analyzing a company's environmental impact, things such as responsible utilization of water and/or energy, limiting CO2 emissions, and avoiding harmful practices like deforestation may be considered. For social impact, things such as corporate philanthropy, community involvement, good working conditions, and progressive pay policies are taken into account. In terms of governance, we think about board composition, corporate transparency, appropriate executive compensation, and limited product recalls, fines, and lawsuits. And you'll see other things included on this list as well. As we've stated before, social impact investing is not new, and over time, the number of social impact investment funds have grown dramatically, as has the public interest and investment. As you'll see here, in 1995, there were 55 social impact funds in existence in the marketplace, with $12 billion invested. More recently, at the end of 2014, over 900 social impact funds were in existence, with $4.3 trillion invested. So quite the amount of growth.
This type of investing has also evolved with regards to the screens that can be used. Originally, social impact investing was developed to exclude the worst offenders. In the 1960s, companies involved in the Vietnam War were excluded. For example, Dow Chemical was excluded for its involvement with Agent Orange. Also, specific products were excluded, such as tobacco or firearms. Now we have more options. We are able to use both inclusive and exclusive filters to make more of an impact. We can select no investment, which excludes investments engaged in a particular activity. We can also select positive investment, which seeks investments with positive impact in a specific area. And finally, we can select a combination of both positive and restricted or exclusionary strategies. An example of that would be, instead of only excluding companies that pollute the environment, we can now also include companies that specialize in clean energy. In addition to both inclusive and exclusive options, there is expanded screening in different advocacy criteria. We can look at things like women's issues or even animal welfare. So really, it's possible to be more specific in determining how you want to invest. This is one of the reasons we're seeing growth potential in social impact investing.
Thanks, Corinne. Here we have a few examples of specific funds that are used within our Bell Social Impact Strategy. The first example is a Global Women's Fund. This is an equity fund that invests in companies both in the US and internationally. And this fund invests in the highest rated companies in the world in advancing women's leadership. Now, of course, we know that there are compelling social reasons for promoting women in a corporate setting, but there are financial motivators as well. In a 2009 study, it was found that there's a strong correlation between a strong record of promoting women into the executive suite and high profitability. So in this fund, we find that 99% of companies have two or more women on their board of directors. When we look at the companies held by the fund, 26% of women are in senior management versus a global average of just 16%. I'll also note that this fund invests in Clorox, which is based right here in Oakland. So this is a good example of also investing locally. The next example is a community impact bond fund. And this is a fixed income fund that invests just here in the US. They invest in things like nonprofits, affordable housing, and small business loans. This fund has been around for a long time. It was launched back in 1998. And since inception, they've invested over 42,000 affordable rental housing units and over 400 SBA loans. We also have a similar bond fund that has invested in bonds issued by Kaiser, another company that's right here in Oakland. Our last fund example is a global environmental fund. This is an equity fund which invests in companies, again, both in the US and internationally. And this fund invests in companies who focus on resource optimization in environmental markets, including energy, water, and sustainable agriculture. One of the many companies this fund invests in is Umicore. Umicore is a Belgian company that was founded in 1902, and about half of its profits come from recycling, which includes recycling of batteries and the recovery of specialty metals from mobile phones. Other business in Umicore includes specialty metals for more efficient building construction and materials used in batteries for lower emission electric cars. By investing in these types of funds, you can support causes you care about and also encourage the business practices of the companies the fund holds.
Thanks, Heidi. On the topic of environmental issues, you most likely remember the BP Deepwater Horizon oil spill that occurred in the Gulf of Mexico in the year 2010. This is a high-profile example of how environmental risk can have meaningful consequences. In the year 2015, the University of Oxford and Arabesque Partners put out a report and the chart you see here on your screen. What the report stated and what the chart depicts is that BP's share price lost 50% between April 20th of that year, 2010, and June 29th as the catastrophe unfolded. In comparison, a peer group of major oil companies lost 18.5% during the same time period. Since the disaster, BP's share price has underperformed this same peer group by a whopping 37%. Interestingly enough, astute ESG investors would have avoided investing in BP at the time of the oil spill. According to Rep Risk, which is a site that provides insights on ESG risk, 2 years before the spill, there was severe criticism of the company's performance in environmental pollution, occupational health and safety issues, negative impacts on local communities, and even labor issues. Additionally, the MSCI, stands for Morgan Stanley Capital International, excluded BP in 2005 from their sustainable equity indices. This was after the Texas City explosion and a perceived lack of action from BP on health and safety issues. In summary, the funds and individuals that were screening for companies with poor ESG controls would have avoided this mess altogether. We'd now like to directly address the misconception that by investing in companies with positive social impact and avoiding those with poor ESG standards, the return of your portfolio will suffer. This slide shows the long-term performance of two indices with the goal of disproving this myth. We first have the MSCI KLD 400 Social Index and the S&P 500. I believe most everyone is familiar with the S&P 500, which tracks the 500 largest companies in the United States as measured by market capitalization. The MSCI KLD 400 Social Index is also cap-weighted, but tracks 400 companies with outstanding ESG ratings and excludes companies whose products have negative social or environmental impacts. What's charted here is the performance of the MSCI 400 Social Index and S&P 500 from July 1990 through December 2014. The dark blue dotted line is the S&P, and the solid light blue line is the MSCI 400 Social Index. The performance is more or less comparable, with the MSCI 400 eking out a small advantage over the S&P 500 over this time period. This is far from the only benchmark comparison or study that addresses the underperformance myth head-on. There are many more just like it, one of which I'll review now. The CFA Institute reviewed a variety of mega studies that address the performance of impact investing strategies and funds in their paper titled Environmental, Social, and Governance Issues in Investing, a Guide for Investment Professionals. One of these mega studies was a report completed by the University of Oxford. This report analyzed 200 studies to assess how sustainable corporate practices can affect investment returns. After reviewing this mega study and a handful of others, the CFA paper concluded that, quote, the key point is that on the whole, the empirical evidence does not support the notion that ESG considerations necessarily adversely affect performance. In terms of the Bell Social Impact Strategy, we use mutual funds and exchange-traded funds, also known as ETFs, exclusively. The same goes for all of the investment strategies here at Bell. This allows for inherent diversification across styles, regions, and industries, as both mutual funds and exchange-traded funds operate as a basket of stocks and generally do not concentrate in one or even a few companies. And in the case of our social impact offering, we can utilize the expertise of the portfolio managers of these mutual funds and ETFs to perform the ESG screenings on the individual companies in question. The database that we use to gather our mutual funds and ETFs is called the Forum for Sustainable and Responsible Investment. This is a nonprofit based in Washington, D.C. They track funds that abide ESG guidelines in some way or another. As depicted in the blue screening chart a few slides ago, no investment, positive investment, or some combination of positive and restrictive are all possible screening options. We take the forum's database and filter out the funds that do not have considerable history, are too small in size for us to have confidence in their liquidity and sustainability, and finally, are not available at Schwab, the custodian we use. Finally, we segregate the funds into 3 risk classes. Those classes are equity funds, balanced funds, which are a combination of stocks and bonds, and finally, pure bond funds. This final list is then used to select the best funds for our clients given their risk tolerance, return objectives, and perhaps most importantly, the issues they care most about and the values they would like to support. Once the investments are selected for a client's account, those funds are continually monitored to ensure they meet the criteria initially established, and further research is done on potential new funds to add to the mix.
Thanks, Corinne. So this Bell strategy can be implemented with many different account types. It's very flexible. So it can be used in taxable accounts like trusts or individual brokerage accounts. It can also be used in individual retirement accounts like Roth or traditional IRAs. And we can use it for nonprofits or even business accounts. This strategy can be used exclusively or in conjunction with other investment approaches. As we've discussed, social impact investing helps connect your investments with your values. This investment style is well established and has evolved to include a robust selection of funds that incorporate many different types of advocacy criteria. And with the Bell Social Impact Strategy, funds are selected according to your risk and return preferences, keeping in mind the causes and issues that are most important to you. That concludes our presentation today, and we've recorded this webinar and it'll be available on our website in about a week. We can also email you these slides if you'd like. And as you can see, we have an inventory of past recorded webinars that you're also welcome to access. Our next webinar will be on November 16th, and this will be our quarterly investment committee update, which is restricted to Bell clients only. Now we have time to take some questions. It looks like we have our first question, and that is there any standardized ESG rating system?
That's a good question. I'm happy to take that one, Heidi. As we've discussed, the interest from individual investors for this investment style is growing rapidly. So we certainly see a demand for a standardized measurement. And honestly, progress is being made. For our purposes and likely other institutions like our own, the forum that I mentioned, the Forum for Sustainable and Responsible Investment, provides us with a robust database of social funds with expansive filtering and advocacy detail. Really, the forum has become a well-known and respected comprehensive source, but that doesn't answer the question. For individual investors who simply want to know how a specific fund or even company ranks with ESG factors, there really isn't one standardized rating system at this point. That said, Morningstar is making strides to develop such a system. I believe it was just last year they announced that they would be developing an ESG rating for all of their funds, and they're calling this rating a sustainability rating. The sustainability rating will measure how well the holdings in a fund are managing their ESG criteria. This is just relative to other Morningstar category peers. And again, the project is underway, and Morningstar has begun to rate the mutual funds on their website, but not all the ratings are complete. But truly, once the ratings are complete, we believe this will serve as a very helpful tool for individual investors to evaluate the social impact the funds that either they own or would like to own are making. So hopefully that helps a bit.
Great. Thanks, Corinne. Looks like we have one more question. So this person says, you mentioned that 2 of your funds have some investment in Oakland businesses. Is that the extent of the local investment? I can take this one. So we do see additional local investment within our social impact funds. Granted, it may not be in Oakland specifically, but it's still within the Bay Area. So one of our funds invests in Safeway, which is in Pleasanton. Above and beyond that, many of our equity funds invest in tech, like Google and Mountain View and Yahoo as well. So I would keep in mind that many of these mutual funds are actively managed. So that means the holdings are going to be shifting and be upgraded on a regular basis. So as we're seeing progressive companies like Uber come into Oakland, we would expect then that the social impact dollars to grow here over time as well. Okay, great. That's all the questions we have time for. So if we didn't get to your questions, we'll follow up with you directly. You don't need to wait for our webinars to stay in touch with us. You can follow us on Twitter, and you can follow our finance and our career and life coaching blogs. Those can be found on our website. And as always, if you have any questions, please don't hesitate to contact us by email or by phone. That's it for now. We hope we'll join you again. Thank you for your time.